All right, we're live. So, hi, my name is Amar Shah. Welcome to Conversations with Kyle, who's a CPA. And today we're going to talk about 3 things you should consider when somebody's passed away. So, in these examples, we're looking at individuals that are married filing jointly and one spouse has passed away. So, the first one, Kyle, tax status.
Yeah, and so part of working with our clients is, we are with our clients in all cycles of life, and unfortunately, some clients that pass away, it does complicate their tax filing a little bit. And so, if you're a married couple and the first spouse passes away and there's a surviving spouse, your tax status can still remain married filing joint for that first year. So let's say somebody dies in 2022. You could use the married filing joint status for 2022, and then you'd be what's called a qualifying widower for 2023 and 2024. So the 2 following tax years after the year that somebody passes away.
Yeah, and that's important, especially from a planning perspective, right? Like, if you get married filing jointly that first year, there could be opportunities to maximize those brackets, which you won't have in later years, right?
That's right. And also, I'm not sure if you want to get into that right now, but just the step up in basis that you receive when somebody passes away can be a huge tax planning tool. In term if you can kind of see it coming, or it's pretty apparent that one spouse is going to outlive the other. You can do a lot of tax planning in terms of getting that step up in tax basis, meaning if you bought a house in 1980 for 1/10 of the price that it could sell for now, the,
Right.
the cost basis would jump up to the fair market value on the date of death for the first spouse. And so you really would have no capital gains or really no income tax implications in freeing up most of your assets.
And that's in community property states, right? Like common law would be just one half would step up, right?
That's right. Yep. And so, for community property, you get the full step up, and then.
So that was actually number 2, right? Is making sure you get a date of death value and get that cost basis. I know from brokerage firms, it's as simple as sending in a letter with a copy of the death certificate, and they provide you with a report to do that. Now, to update those cost bases, you actually have to do some work, or the advisor will have to do some work to get them updated. But you can get date of death values. Also, I think it's important, like houses, right? Like, if you're in a high, you have a high total net worth, maybe getting an appraisal and, doing a 709. I'd just say to get all assets appraised at the time of death. So that way you have accurate reporting there.
Yeah, especially if you have any estate tax implications, it's required that you get evaluation. But let's say you're still under the filing threshold of the estate tax. I would still recommend getting evaluation done, especially if you're going to hold on to specific assets and sell others. And, it's not as much of a consideration when you sell everything within the estate within 6 months. But let's say you have a vacation home that you want to keep in the family, and then you're going to sell the personal residence. Well, you want to get a valuation done on that vacation home just so you can establish what your cost basis is at date of death. Because as we know, real estate prices can go up and down, and any asset values can go up and down pretty rapidly. So establishing what the value was at date of death to establish your cost basis is really important.
And sometimes, when you talk about volatility, because we're going through a lot of volatility right now, there's the alternative 6-month valuation, right? So that could be part of the picture as well. So it's good to get those cost basis. And the third thing was, Kyle?
Was just the when the second spouse passes away, just having a succession plan in place, some continuity with either your advisor, your CPA, or your kids, or whoever the executor of your estate will be. There's also third-party trustee services, and just making sure that those things are in place for when the second spouse passes away, so you can get the tax filings done and not pass that on to your heirs. So
Yeah. And that's really important because there is a final tax return you have to do, right? So maybe you can talk a little bit about that, or maybe that could be a whole other video, but just cliff notes of when the second spouse passes away, there's a 1041, or I'll just let you.
Yeah, so there's a final 1040 to file. Let's say somebody passes away February 28th, 2022. You'd file a short year 1040 from January 1st to February 28th. And then you could elect to do either a calendar year, a state income tax return, or a fiscal year, but depending on the date of death. And you'd have to file a 1040 until all assets of the estate have been distributed to the heirs.
Yeah.
So
let's end on that. So there's 3 things to consider when a spouse or a family member passes away. Just remember, tax strategies that you can use that they're very time sensitive because of tax filing status changing, cost basis to get alternative cost basis or a step up in cost basis. There's some legwork there. And then also when the final second spouse passes away, some legwork that still needs to be done. If you're enjoying these videos, please hit like or subscribe, and please put comments down below. Both Kyle and I do a proactive job of reading those comments, and we like to keep this a dialogue. Thanks.
thank you so much.